Welcome to Your Money, Your Call, the Friday night edition of Bonds versus Equities. My name is Mark Todd and I'm from FIIG Securities. If you have any questions on the share market or the bond market, please pick up the phone and call us on 1300 30 34 35, or you can email us. The email is yourmoney@skynews.com.au. Joining me tonight is, on the panel, we have Rudy Philip van Dijk. He is the editor of FN Arena, and we have Ben Smith, who is the managing director from Investec, the investment bank arm of Investec. Hello guys, how are you?
Hi Mark.
I suppose the thing that last week we had a great rotation, and we still continue to have the great rotation, and I think...
Still think that's BS. That's not happening.
So everyone were on and they like the fact that PIMCO created the term and it's all really good. But then they try to work out, did it really happen? And the theme that we've been working towards in the Great Rotation was that everyone's moving into dividend-paying performance. They had all been in fixed income, and they're all moving into the dividend-like performance, which is the banks, and it's with Telstra. And one of the things I wanted to start today was to show a graph in terms of how the term deposit market has been reshaped, and how the banks are looking to respond to that term deposit piece. So what we've got up here on the screen at the moment is, bearing in mind that all these rates, there are an array of rates. I've just taken 5-year rates to start with. The lower rates, as you can imagine, it's the major trading banks. So it's just the average of the major trading banks. And I picked two of the banks. I picked Rabo and I picked, of course, Investec, because Ben's here from Investec. And the idea being that the fifth pillar, which is all the credit unions, it's just anyone that's not the big four, that is, and I put into the big four all the banks that they own, Bankwest and the like. But it's all the institutions that are regulated by as an ADI, an Australian deposit-taking institution, and Investec falls into that. So the rate here, you're looking at closer to 5% versus, 4.5 or 4.40. In my mind, I think that Investec and Rabo and organisations like that are using this higher rate, and this is to you, Ben, as an opportunity to win customers over. Instead of spending a lot of money on the brand recognition as the other banks do, I think you guys are starting to use the term deposit market as an opportunity. Is that a fair way to describe it? Am I giving you guys too much credit?
Oh, yeah, it is, Mark. It's one of the many things we do, and I think the term deposit rates, we consistently aim to be competitive, but it's only one part of our cash capability. So, as well as term deposits, we also offer transactional banking accounts, at-notice accounts, FX, and all of that on an online platform with very high levels of execution and service. So, yes, the rates are important, but they're only one part of a wider cash capability.
When you look at how much money, Rudy, that CBA made out of retail, you can see why Ben and those guys would want to have that business, because if you can get into that piece, it becomes very attractive, isn't it? Retail wealth management, lifted CBA to new levels.
It's something that, to my surprise, when I came to Australia 12 years ago, I thought that Australian banks were underestimating anyway, because it is in a way it's cheap access to money, isn't it? Otherwise you have to go offshore and have to get it, and often at a much difficult means. So that's probably the good part of the crisis, that Australian banks have now realized that's much easier access of funding, and they have obviously used it over the past few years.
That's right. I think
as a replacement of the overseas ones. Yeah.
That's right. I think that the overseas experience was quite disappointing for the banks in the middle of the crisis. They'd gone to all these organisations and they'd religiously issued paper. They'd had great relationships, and the moment the crisis hit, we weren't friends anymore.
No.
And they wouldn't take their paper, and it was. I remember sitting with Bank of America saying, "I can't borrow 30 days." I mean, yeah, you're Bank of America. How can you not borrow 30 days? And he said, well, I could probably hit a price and borrow, but the first thing that happened is I'd lose my job because I paid too much. And the second thing that would happen is the price would move much further away, because everyone said, wow, BA paid here, the price must be much higher. So that crisis taught the banks a lot about trying to spread that risk, and they put it back into that term deposit piece and became massive.
It also shows you that, just as a sidestep on that one as well, it also shows you that herd behavior is not just something that happens in financial markets. It happened in those days. Everyone was doing the same thing.
Yeah.
Everyone was doing the cheap overnight funding, and all of a sudden when that model came to a crashing halt, everyone was being guilty of doing the same thing at the same time.
Well, I suppose, Ben, they were making so much money. You lend long and borrow cheap. Borrow low. You borrow 1 month money and you lend for 10 years for a mortgage. You make a lot of cash out of that, don't you?
Yeah, you do. But going back to your point, I think at that time also, not only were the overseas funding opportunities more limited, but I think people were also bringing their money closer to home, and I think there was some value placed on the security of the Australian system. You know, it didn't matter whether it was because of the government guarantee or just the fundamentals were very strong, and so a lot of the money was coming home anyway. So it did match up with the desire to get more deposits.
And certainly at FIIG, you know, the growth in that business model in FIIG became massive because everyone wanted a fixed income response. So they either wanted it in the form of a term deposit, and you could get Suncorp at 10%. You could get banks at crazy rates. You know, not crazy, but it was the appropriate rate at the time. And then you were getting all, you know, it would be a Telstra bond, it would be a Westpac bond at 6.5%, 7%. You think, you know, if I get 6.5% and 7% on these sorts of bonds, you know, I should be buying those. I mean, nothing against any of the equity people who can talk about that. So, really, I suppose the drive for the yield has created some interesting opportunities. So I think we're trying to pull up a chart that Rudy's provided us. Have you got that chart? So let's talk about, this is Macmillan.
Yes. Well, see, I'm going to say something which is probably against the grain here. I think, and we now see herd behavior against people moving from cash into dividend-yielding stocks in the share market. I think that's very beneficial if you are already in the share market and your prices are going up. I think if you are still looking into moving into the share market, that's now become a really crowded event because the valuations, obviously, I'm going to say the very simple thing, a year ago the valuations were much, much more attractive and nobody was moving cash from the sidelines. Now everyone's moving cash from the sidelines and the opportunities are getting smaller now, I believe. The big opportunity that investors have missed, and this is one I've been pointing out for years, but I mean, few people are listening. That's why we just had the chart up from Macmillan Shakespeare.
Yeah. See,
people look at the share market and they look at the share price. Yeah? And obviously in Macmillan Shakespeare case, it has outperformed the index massively. And its share price is nicely up in a time when we had a bear market. Yeah?
Yep.
But the real value of owning Macmillan Shakespeare over the past few years was what you don't see in the chart is the dividends.
Yep.
Yeah? And the funny thing about, this is the secret of the share market, which a lot of people don't really realize. If I bought Macmillan Shakespeare shares 3 years ago, and I kept them until today, my dividend yield on the original purchase is now 15%, fully franked. 1.5. Yeah? That is what you can do with the share market. But not now, when everyone's moving in and pushing those prices so far up. Now you have to be happy with 6% at best, and hopefully they'll grow a little bit in the years ahead.
But do you notice it with everyone in the equity market? And this is, it's a broad generalisation. And
which probably is correct.
And they all want it to, it's like a rugby game or it's like a soccer game. You know, did your team win? Did the equities go up? Yes. Because it's so important, they've got to go up. And everyone's bought banks and they bought Telstra.
I know, and they all do the same thing at the same time, and they don't realise that that is not the smart way of investing.
Yeah, so it's the idea that they want to move it into, you know, the cyclicals, they want to move it into the things that aren't the banks, and they want to see that there's genuine movement. But I suppose, Bender, the way the world looks globally, cash rates are low for a reason. You know, there seems to be, you know, your interpretation, when you see, as an investment banker, you're talking to these corporations, how does it feel in terms of their performance? Do they feel that incomes are growing, everything's solid, we're going to start employing people, or do you think they're still inherently cautious?
Oh, I think there's a lot of caution still out there amongst the corporates. You know, you look at the experience of the reporting season, and been some very strong results, but there have also been some disappointing ones. No real calamities as far as, you know, the bigger stocks go. The retailers, Christmas was mixed. You know, it wasn't the sort of shot in the arm that a few of them were looking for, but it was better than some bears were suggesting.
Yeah.
So there's caution out there, but I think people, you know, realise within the companies they've got to start growing again.
And is it driven? Growing. Yeah. Because I was watching some reports today, they were talking about the fact that cash rate's so low, it's because the RBA, all the policymakers want you to start taking risk assets. If I could get Glenn Stevens here right now and ask, was that true, he would fall over. We'd have to resuscitate him. Because they don't want you to take risk assets. It's not what they're trying to do. What they're trying to do is have economic stimulus. They want economic growth. So Bernanke wants the housing market to consistently improve in the United States. That's where the problem started. That's where they've got to get it solved. It's clear that it's around trying to get people to have some confidence, and they don't inherently have it.
That's true, but the side effect, especially from the US, is that people are forced into higher risk assets because the so-called safe havens don't generate anything in return anymore.
But when you say that, Rudy, and I'm not disagreeing,
Yes.
but who are the people? Is it PIMCO, or is it Mr. and Mrs. Smith on
Yes.
180 Elm Street?
I think it's PIMCO and the likes, because I mean, these guys obviously have to advertise at some point and have to offer something to their customers, and having to tell their customers that they might get 2 or 3% on their annual overview of what the fund made for them, and then the fees have to come off of that. That's not an attractive proposition. These guys, and there's criticism as well that a lot of fund managers are still in the mindset, also in the US, that they can still promise their clientele 8, 9, 10% a year. I mean, and there's no way they can do that when a lot of money of that is parked in bonds now.
I mean, clearly PIMCO made 10%. You want to...
No, I do. I just on the point of safe havens, but as people's perception of risk improves, then the definition of a safe haven changes.
I totally agree.
And so it's no longer just a US Treasury, it's become CBA equity or, you know, these high-yielding stocks, because it's unattractive to get
I agree,
1 or
but
2%
there's some other issues as well. To my understanding, for instance, the gap that's normally there between lower ranked bonds and higher ranked bonds is now very narrow again. So criticism is that as that money is pushed towards higher risk assets, that risk, you can argue, risk is now mispriced. And as I said earlier as well, you can argue whether a share, an equity like CBA, for instance, is priced at bull market multiples, while arguably, I mean, they had these kind of multiples when they were growing at 20% a year. Now they get these multiples by just doing 5 or 6%, and that's a big surprise.
Well,
we're going to have a further discussion on those compression spreads, because there is some theme around how they didn't go out enough, that there wasn't that spread. But we've got a caller. Richard, you'd like to talk about fixed income, I think.
No, just the advantages. Asking Rudy the advantages of reinvesting dividends. Page 22 of the Fin Review today, according to Perpetual, $100 invested over 100 years ago and reinvested would now be worth $26 million, and the same amount of $100 in cash would be worth $79,000. A Porsche bought 25 years ago for $200,000 and now be worth $20,000. BHP shares the same amount. 1987 dividends reinvested would be now worth $5.4 million. So just Rudy's opinions on that. I've been a CBA holder also, Rudy, since 1993. My dividends, I suspect this year will be $3.50, which is a reasonable amount on an initial purchase of $6. Thanks, mate.
Well, there you go. I mean, Richard, I mean, what can I say? I mean, the kind of things you're questioning now, or pointing out, I should say, and I've been pointing them out for years. I mean, in early 2010, and this is probably going to answer your question like no other, I wrote a story where I compared the 8-year returns on owning Rio Tinto and David Jones shares. The result was, because we had a super cycle coming, I mean, the result was that everyone thought, like, well, Rio Tinto shares are gonna beat David Jones hand over fist, and there's no comparison here. The result was that David Jones shares, only on dividends, matched the return of Rio Tinto shares over that period. So whatever David Jones did in share price performance was the bonus on top of the dividends.
Right.
Yeah. So that shows you that if you go to the share market and you can pick a stock that grows and grows its dividend and you keep it for an X amount of years, there's simply almost nothing else that beats it.
So we'll talk about that, but we will go for an ad, and we'll talk about Porsches and the like, because it'll be very interesting. But before we go to an ad, we're going to go to Ben. We're going to have a speed round for 30 seconds. And Ben, as you know, last week we had this, and it'll be the same questions. At the end of the year, where do you see the cash rate? Where do you see the All Ords? Where do you see the fixed income market, and where do you see the currency?
Okay.
So your speed round will come up on the screen, Ben, and you'll have 30 seconds to engage us with these fine thoughts.
Okay. Cash, I reckon, will be about 50 basis points off where it is, two rate cuts over the course of the year. Currency probably a little bit weaker. I'm not an expert on these things, but I would have thought, you know, high 90s, maybe parity. Equities, I know there's been a long rise, but 5% increase, maybe more if the bond market is up, if the US market is up, and bonds, I think, pretty stable.
All right.
sector de terra calicity. Mozzies, your time is over, but we have the long-lasting protection of Aerogard Tropical. We can stay out and reclaim what's ours. The camping spots, fishing spots, bushwalks, and Barbies. Because at the end of the day, it's the Aussie summer, not the Mozzie summer. Reclaim yours at aerogard.com.au. Try new Aerogard Low Irritant Gel. It's great for kids.
TPG presents our Unlimited Bundle. Get unlimited ADSL2 Plus with home phone line rental. Unlimited calls to local and standard national numbers. Unlimited calls to Australian mobile numbers. And unlimited calls to selected international countries. Plus a Wi-Fi modem. All for just $79.99 a month. Yep, $79.99 a month. TPG is a multi-award winner.
tpg.com.au.
If you're thinking you can't do all the things you want until you knock down your credit card debt, you should be thinking ANZ. Transfer your non-ANZ credit or store card balances to an ANZ credit card and get 2.5% per annum for a full 15 months. Manage your money your way. Go to anz.com/balance transfer, call 133333 or visit a branch.
You know, it's one thing to say you're separating.
And quite another to go through with it.
And, well, now I need to look to the future.
And so I was after a fair property settlement, not a drawn-out legal mess.
And fixed fees, so I knew what I was up for.
And that meant calling 1-800 555 777.
Slater and Gordon. Not a problem.
Welcome back to Your Money, Your Call. My name is Mark Todd. I'm from FIIG Securities, and tonight I'm joined by Rudy Philip Van Dyke, editor of FN Arena, and Ben Smith, the Managing Director at Investec for Investment Banking. They're here to answer your questions, so please pick up the call and call us on 1300 30 34 35, or you can email us yourmoney@skynews.com.au. I wanted to move it on. You know, I'm not trying to denigrate any hybrids. Hybrids are very complex things. The documentation around hybrids, you see, with some of it comes out and you look at the documentation you wrote and you think, how could they write that, and then how could they get it sold, and some of it's very onerous, and you know that the risks inherent in the document said that this is a risky asset, but it still trades at the similar prices to non-riskier assets. And one of the things that had happened was Westpac came out with a $1 billion issue, and without having to go through all the maths of it, you can see why the banks really want to do this. The cost of funds in hybrid world is very, very cheap. And $1 billion goes, it's very easy for the stockbrokers to sell it. The bond market is slightly harder, and there's all nuances around. So what I wanted to do was bring up a chart. The National Australia Bank's about to launch one as well.
Yes.
And we're going to look at the two different charts. This is the NAB cap. Do we have the one that compares the three hybrids? There's another chart that'll show the hybrid market. NAB cap is a secondary market bond, and you'll have to go again. NAB market is a secondary market bond that trades amongst the professionals. It is open, it's available to wholesale investors. And here's some of the terms and conditions on the bond, but there's one chart that we've got that'll show the comparison of the three bonds, and I'm hoping that they'll bring it up soon. Essentially what happens is the NAB caps matures in 2016, or its call date is in 2016, so these new listed hybrids, you don't get your money back until, it says there, 2019, or they get converted into equity. Yes. And you and I were talking about offline. Yep. What do you think about the conversion clauses in these things?
I was surprised at how tight the margin was compared with the existing paper that's out there. I think you don't get any uptick on conversion, or not a significant one. And as you were pointing out, Mark, the timing that you get your actual cash receipts of the dividend plus the cash receipts on the tax that you'd get on the franking credits is inferior to the bonds.
I mean, Rudy, you know, yeah, you love the frank dividend world, or you're an equity guy, you love all the franking. And a CPS gives you franking. So let's say we issue in February. You'll get your payments in February, May, August, February.
Yes.
So, November, sorry. That's when you'll get your payments. So, in the tax year, you've got 3 payments in which you can't claim until you've waited 9 months or 6 months and so on. You keep waiting. You've got to be quite prompt with your tax return. In terms of the way the NAB cap, the secondary market one performs, you just get cash. If you buy $1 million worth of those, you get cash at 6% or whatever your cash component, whatever the floating rate is, and you then can reinvest that money. You can use that money. At the moment, I think the exuberance around franking affects the performance of the bonds. It's easier to sell. It's franked. You should buy this.
I think what I mentioned earlier, when everyone is moving and doing the same thing, I think it was last year or the year before when there was this big wave and everyone was moving into hybrids. And I think it's the same thing. It's not because everyone is doing it, it's the right thing. And I mean, I'm not an expert on hybrids, but my understanding from quite a few people who are experts in that market, they were telling me that a lot of those hybrids were not fully priced for the risks that are inherent in those products. It was simply a matter of there's an audience out there that wants yield, will give them yield, and that's obviously the beauty of financial markets. They will respond to demand. But it doesn't mean that everyone who moved into those products did the right thing for them, and they were aware of what they were actually putting their money in. I think the focus was too much on yield.
And you would know yourself, it's so much easier if you're a NAB or you're a Westpac to sell $1 billion. If Investec comes out and says, I want to sell $1 billion these hybrids at 325, people would say, well, I'm sorry, I don't know Investec.
Whereas, you could do it with the blindfold on and arms tied behind your back.
I mean, it's literally, do you want to buy Westpac? Everyone likes Westpac. Yeah.
But on these ones, I guess the reason why you might like them better than the NAB bonds, which they rank with, would be that you think that, in 2 years' time, the next issue is going to be at a lower interest rate because there's been further compression of yields.
Yeah, I think that
because the bonds 3 years shorter tenor, aren't they?
That's right. That's right. So, but the point about these ones, and we had a chart that we haven't been able to bring up, is that they trade. The way a curve works, the way a normal curve works, the curve that we will now construct is if I gave you $10 today, I'd want the money back tomorrow. I might want $1, 10 cents, 20 cents. Yes. But if I gave that money to your man with a compound for 100 years, and I hope you can keep it for 100 years, I'd want a lot more money coming back. Well, the NAB is
over time.
That's right.
Not immediately, but over time.
So the NAB is 2016 maturity. At 2019, 2021 maturities, you should think that the NAB caps would be lower. But it's not. It's giving you a higher return and a shorter tenor, so that's quite attractive to any investor. So that sort of makes a lot of sense. And we've got the NAB equity piece up there, I think. So, the ever-performing NAB, if they could sell something in London, they'd be pretty happy. Clydesdale, as an Englishman, those Clydesdale banks just can't get sold out, are they?
Well, they probably can sell it, but that would be at a fire sale price, and they don't want to go there.
When you talk to the people about not the people at the NAB, but you talk to people about the NAB, and then they say, when they sell at a fire sale price, I think the question for the NAB is getting any bid. When Banco Santander was in the papers as a potential buyer, the NAB share price rockets. At least there's a buyer. I don't think there is a buyer. Any buyer. It doesn't.
No, it's been pretty well trawled for. I think there have been 3 or 4 attempts. So
as an investment banker, when somebody comes up to you with that mandate, you must look around and say there must be a bid, and then just.
Yeah, I think that's probably right. I think, you take them on and take those kind of mandates on, knowing that there's been previously unsuccessful attempts, but you think the world might have changed.
How's that conversation going back to the head of the NAB? Go back to Clyde Cameron and say, look, there isn't a bid for any of your bank. That would be a very tough call, wouldn't it?
Yeah, it would be.
Well, I think.
Please pay me a couple of dollars, and I'm going to go and tell you that you have something that's unsellable. It's just.
But to jump into that, I think what has scarred Europe. I mean, a lot of those banks in Europe, they had previously been buying banks, for instance, in Cyprus and in Greece. Then Greece ends up in trouble, and they have to write down billions of assets because all of a sudden they're worth nothing anymore. So I think a lot of those European banks, when they look at something like those Clydesdale operations, they probably have the same thing in the back of their mind. They go, what do I pay? And then I go to the books, and the UK economy is not necessarily, it's as worse as it's ever been since the 1930s.
Yeah, absolutely, it's terrible.
So, you're buying a bank asset in such an economy where you probably think more about the risks down the track than what you're immediately getting in assets.
Which is probably a good idea to think about the risks down the track because the economy there is so weak. It's such a poor economy at the moment.
But the challenge, especially, I don't specialise in the banks, but they face a similar problem to a lot of very big Australian corporates, is that you get to a certain point in the economy, in size in the economy and market share, and you've got nowhere to go in terms of growth. So what do you do? What do you tell your shareholders? I'm only going to grow at CPI plus a few %, and that's not very exciting unless
And the point is that you, as a person that runs one of the four banks, you know, you've made this dance with the devil. I'm going to give a 6 or 7% yield, and that's why my share price is where it is. And in the event I can't grow it, you know, I either move staff offshore or I find any other way to grow it, because the problem is if I can't keep that dividend performance, my equity price will be moving down and my bonus won't look like it ought to be. Which of course would never happen at Investec. Tell me about Investec. You know, give me some sense of the organisation. It's Australia, it's London, it's South Africa.
That's right. I mean, I think we're actually quite a substantial organisation. We've got over 7,600 employees across 14 different countries in the world. 3 main geographies: South Africa, where the bank started in 1976, the UK, and of course Australia. And across those geographies, we call ourselves a specialist bank and asset manager, and we lend, we advise, and we create investment products. So that's what we do. We do that in Australia. We've got about 450 plus employees here in Australia, and we operate across private banking. If I call it wholesale banking, we're involved in leverage lending to corporates and private equity firms. We're involved in resources finance, commodities trading, some fixed interest. And then in the area that I work in, which is investment banking, we're involved in equities, but only in the resources sector. And then our advisory business covers 6 or 7 sectors in the economy. So we provide advice to corporates, to governments, to high net worth individuals around their businesses.
And that business, is that a growing business at the moment? Do you just see, you know, natural growth because of, you know, being more nimble than the 4 majors, or do you find that do corporates need to have an independent voice and say, okay, I've got you or Macquarie Bank? Is that how they look at it?
Oh, I think...
Or they don't look at Macquarie Bank anymore, I don't know.
Yeah, they're still very active in the markets that we compete in, Mark. Yeah, I think they do. I mean, I think boards making big decisions, they want an external pair of eyes on things, and the trend these days is often to have more than one advisor involved. You know, they're making big calls, and they want advice. And, you know, it's not every day that they've got to respond to buying a big asset, selling a big asset, responding to a takeover. And so they bring in advisors.
And do you feel that the directors are more conservative because of the amount of regulation around the performance of a director now? Is that just continuing to grow?
I think it's one factor. It is, you know, there's a layer and layer and layer of different responsibilities that you have, both, I guess, from a legal point of view, but also from a, you know, responsibility to your shareholders, a fiduciary responsibility.
Do the right thing.
To do the right thing, yeah.
Rudy, we're going to talk about your business, but before we do that, we'll do that after the ad. We're going to go to a short break. Please give us a call on 1300 30 34 35 for any investing questions. Or you can email us on yourmoney@skynews.com.au, and we'll be right back after the ad break.
Wake up to Alive, the new high-potency multi from Blackmores for daily energy.
It's wonderful, it's marvelous, it's what I love to see. It's wonderful, it's marvelous, that you should care for me. I like the way you move.
The new BMW X1. Change the way you move.
When it comes to a freight partner, size and innovation matter. Our huge network and 3,000 vehicles guarantee fast, reliable delivery across Australia. We're proud of our history and our growth. It's a tribute to our people and their dedication to customers, providing fresh logistics solutions and new ideas like auto-sort technology, supported by a service-first commitment and total care for every package. Bigger, better, faster. Star Trek, when service matters.
Welcome back and thank you for joining me at Your Money, Your Call. We have on our panel tonight Rudy Philip Van Dyke, from editor of FN Arena. We have Ben Smith, who's a managing director from Investec. If you have any questions, please give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. I think we're going to go to a chart that we thought we had, and here's the one that we were talking about earlier. What we were trying to show with that is that the NAB on the right is the NAB secondary market bond. It trades at higher margin. NAB is supposed to come out with an issue. The range, the reason why it's grey up the top there was the expected range is 3.2 to 3.4, and you see West out there at 3.2. So you can see that in terms of the performance, it's trying to highlight more that it's a significant performance for a shorter dated asset. So thank you for putting that up, guys. Let's talk about your business. Tell me about FN Arena.
Well, we started 12 years ago, right, and we started off with which we thought at the time was rather a novelty, especially in Australia. We amalgamated all the research from the major stockbrokers and we made that available to a broad audience. That started off as the Australian Broker Call Report, which was the first original in its kind. We're still doing that today, and we publish it every day. But we by now have added our own calculations, so we do now consensus price targets, consensus forecasts, and things like that. And since late 2007, we added our own market research on top of that. Before that, we were just reporting what the experts were doing. But in 2007, we found ourselves at a complete distance for what the experts were saying, because we thought that the banking sector was going for a big shake-up and we were heading for a bear market. And nobody else was saying that. Everyone was saying, I'll stick with the banks and it's going to be okay. So from that moment onwards, we started adding our own market research, and I think we've done well since then.
And how successful has that become? Have people responded to it a clear voice and said, look, that's great, and you see the subscriptions? I take it as the subscriptions?
Yes, well, it's a dual model. A lot of online businesses have by now moved to a dual model, and they all start off as a subscription business. We from day one had a dual model. We have part subscription and part advertising and whatever there is on income on that end. So you can be a subscriber, or you can just be on database and not pay for anything, and obviously you don't have access to everything then.
So is it like the Times? You know, if you use it a couple of times, then the price points pick up. Is that how you do it, or do you
no, it's just flat fee.
So how do you get a client involved in that? How do you get them interested in that? Is it just word of mouth, or is it marketing? What do you do with
word of mouth? For us is probably the most important asset we have.
Right.
I mean, we've all been now through 5 years of bear market. Yep. The only reason why we are still in business is because we have a collective of very loyal clients.
Can I ask who those clients are, Rudy? Are they private investors or institutions, or a mixture?
We have a very big weighting towards professionals, which probably won't. I mean, if you look at what we do with the broker information and the calculation of the targets and stuff like that, that's probably not going to surprise anyone. So we have the hedge funds, we have the fund managers, stockbrokers, that type of customers. Yeah. And on the other end, we have obviously an increasing number of people who do their own super managed fund, or although they have thinned out over the past 5 years, we used to have a lot of day traders and professional traders, but a lot of them have either moved on to Forex market or done something else now.
One of the themes that we like to talk about is the fact that there's 500, 600,000 self-managed super funds. Yes. They're growing at a rapid rate of knots. And the idea that you are let's say you're an engineer all your life, and then you look towards getting into retirement, and how to get upskilled in terms of all these financial products. And that's why you see the four majors rally, you see Telstra rallies, because it's easy to understand. Yes. And that's why the bonds, if we sell a Telstra bond, it's easy to get together with that. It's fine. We sell Sydney Airport bonds, things that people are familiar with. When we sell an AXA and a Swiss Re bond, trade at between 7 and 8%. in Australian dollars.
Yes.
You need a level of sophistication to understand the opportunity that equates to. But when I look at 500, 600,000, when do they have time to do this? You know, I would have thought you're looking to retire as an engineer, you're probably thinking more about, you know, bridge, golf, tennis. You know, that's where you. But they all want to do it because they don't trust anyone anymore. That, you know, the financial markets have dealt a very bad hand through the GFC, and people just don't trust.
I think you have two very important points. I think one of them is that everyone who tries to do it themselves, it finds out sooner rather than later that it's much more work and it requires much more education and knowledge and insights about things than you would think at face value. Because it's not just as simple as just buying the 4 banks and BHP and Rio and then just sitting back. And the other thing is I've been surprised over the years as well, not just from the investors who are doing their own super fund, but also from people in the industry about big lacks of knowledge about investing and the share market in general. And we definitely have had over the years a very strong educational element to us. But it is, I mean, you'd be amazed how simplistic and how simple a lot of people look at the share market. And it's actually, there's much more to it, right?
Yeah, and it can be more complex or it can be simple.
Yes.
So you could take a simple perspective and say, I'd like to get a 6% return and therefore buy those banks and make life much more simple. Or you can say, I'm trying to beat some hypothetical index. And to your point about the compounding growth, and everyone understands, I mean, a lot of people understand that. The reality is, you don't invest for 100 years, we all know that, and we know, you know, Buffett does it so well, he explains it so well, but the point is, people are at a point in time where they have the lifestyle choice where they need to use that money to live on. So I get it that people say just keep that money and let it compound forever, but 85% of the people we're talking to are using that money to live off. So compounding becomes, okay, when I tell my 14-year-old, when I tell my 85-year-old father-in-law, you know, compounding is not so hot on.
You're right.
And he gets the math.
You're right.
Trust me, he
But
does.
that's why I think the education starts. Most people start thinking about that when it's way too late and when they need the money to live off, yeah?
Sure.
And before that, they think, oh, when I'm young, I just do the share price thing, yeah?
Sure.
So when they do that earlier, as I gave you the example of Macmillan Shakespeare, which is a very good choice of mine, but in 3 years you can have 15%,
Sure.
yeah? And it's fully franked.
And-
yeah?
and
if you think like, oh, I don't need that because I'm 32, well, you're not doing the smart thing, in my view.
Well, our view would be that you'd buy inflation index bonds. You know, you buy Sydney Airport. That's produced, I think it's about between 15 and 20% over the last year. So I get it. I don't disagree. I just think you need to be conscious of the fact that there's lifestyle choices around all these investments. And it becomes hard to work out what my lifestyle portfolio looks like.
See, one of the difficult things I think a lot of people are facing when they do it themselves is realizing the difference between, for instance, buying a Maya today, which supposedly offers you like a high dividend yield, and buying another stock, which maybe in 7 or 10 years' time will still give you that dividend, and Maya may not.
A magnificent segue, because that's what we wanted to talk about. The Maya, you know, as the private equity world, and they're the people who will be sometimes your customers, how do you see the future? We've got cash rates so low. You know, I talk to the guys in the States. You can be a private equity firm in the States, and some of these organisations, not everyone, but some of these organisations can go to the government and get 10-year money at 2.5% fixed for 10 years, and then they just go on for assets to buy. So the returns that they're generating to themselves and to their clients are massive. But the private equity piece, I read in the paper today, it's got a little bit of a problem, hasn't it? You know, Maya wasn't necessarily the issue of choice.
Yeah, so I think what you're saying is it's if they got the funds, the equity can raise the debt, and there is a difference between different geographies as to how much debt you can raise as a private equity fund. That's fine, but the problem they've got is, or a lot of them have got, is they can't then exit from those investments. So they've got pressure from their investors, who are super funds, high net worth individuals, sovereign funds, to realise those gains that they've made on paper in these investments. And that's a problem, particularly in Australia. As you said, the Maya float was a bit of a high watermark, or depending on how you look at it, a low watermark. And, you know, it's created, I mean, there are many other factors. Obviously, equity markets have been very weak, but now you're seeing stronger equity markets. You're seeing this sort of pent-up supply, not only from private equity, but you know, let's talk about those ones. Good companies, you know, they'd be good candidates for being on the public markets. And, you know, we don't know yet. Everyone's saying this is going to be the year of the IPO, but we haven't had a big one yet. And I think...
Is everyone saying that? I haven't been saying that.
Well, maybe I'll talk to the investment bankers.
We can talk about... you know, Warren Buffett in a minute when he's having a crack at Heinz with the private equity.
There's a reason why you buy Heinz. Yes.
We've got Justin from Canberra on the phone. I think he's going to talk about, I think it's equities. Justin, are you there?
I think we lost him.
You might have lost Justin from Canberra. Buffett.
Yes.
Heinz. You know, it's a great brand. It's a great name. It all makes sense.
Yep.
I haven't even looked at it. It just came up in the paper yesterday. But what was your first blush on that, Ben?
Well, I wish I had the energy that Warren Buffett has when I'm his age. But I hope I'm alive. At the same age was my first reaction. But no, I mean, it was a classic one for him in some ways, but very different in others. It's it's a very well recognised brand name. A very stable company. I think it's had its issues, but it's been on the recovery path for 3 or 4 years. But so in some ways it's a classic one for him to buy and hold for the long term, or Berkshire Hathaway to hold for a long term. They paid a reasonably high price for it, sort of 13.5, 14 times EBITDA. But what was unusual, he did it with a partner who is, whether you call them a private equity fund or a high net worth, a very rich Brazilian backer.
Why did he need that? I mean, that's...
Well, I don't know. And that's some people are saying, well, he was the guy who thought of the trade and came to Buffett with it. But I don't know. That's unusual for him. He doesn't need it. Berkshire Hathaway have got, I don't know, 60 billion or something sitting, or they need to have cash.
Yeah. We'd like to see them in turn deposits. They'd have a real crack.
Listen, I don't know why the partner, but I wasn't surprised at all about the type of company Warren Buffett buys, because this gives me an opportunity to have a little plug. I published earlier this year this booklet which is called Make Risk Your Friend. This explains why some companies are different from others, and I call a particular category of companies all-weather performers in the share market. See, Heinz is, if I would have written this booklet about the US market, I would have nominated Heinz as an all-weather performer. And it doesn't surprise me at all that a smart investor like Warren Buffett buys a type of company like Heinz. See, Warren Buffett would never buy something like a Rio Tinto or a Fortescue, but he will buy Heinz. And before that, he bought a company which is probably similar to, let's say, an Orion in Australia or an Oceano. And that's a complete different type of... And that is something that also belongs to the education about the share market. It's not because someone offers you something, like the Maya float, and they get it away, it doesn't mean it's high quality or it will suit your investment profile. Because it's not that someone can push it away, that you as an investor should jump on board and should buy it. There's a lot of rubbish on the share market, and it goes up and down every day. And that's also part of the difficulty in the process. That if you're doing your own super and you buy a little bit of rubbish stocks and the market goes down, then your losses will be much higher than if you have a different set of
Absolutely. You need to be more conservative, buy bonds. Now we'll leave this here, but we're going to go for a quick break. But before we do that, Rudy, we're going to crank up that speed clock again. Now it's about the cash market, bonds. You got it. Go.
Okay. Well, listen, I am going to be a little bit controversial here. I'm not going to give any calculations or forecasts about any of those four assets. And you know why that is? It's because it's very handy for economists to give their view. It's for super funds to make a benchmark. But you as investors couldn't care less. You just do your homework, buy the right assets, and stick with it, and make your returns.
As you've dodged all four questions, we'll go to a break.
Jetstar's Japan 2-for-1 sale is on now. On selected flights to Tokyo and Osaka, 2 people fly for the price of 1. There's a one-way Jetstar starter fares and must be booked in pairs. Check baggage not included but may be added for an additional fee per passenger. Selected travel dates in 2013. Sale ends midnight daylight savings time February 19 unless sold out prior. Conditions apply. To book, you must click on the sale banner at jetstar.com.
The all-new Honda CR-V, available in 2- or 4-wheel drive, each with a host of standard features, like one-motion fold seats, reversing camera, and clever thinking. That comes standard too.
If you venture, you can't beat a self-drive holiday along Explorers Way between Adelaide and Darwin. See it all in style in a Brits four-wheel drive camper. Book now and get 40% off rental at adventurealltheway.com.au. Start your adventure now.
What's the best protection for dogs from fleas and deadly ticks?
Advantix.
It kills fleas and ticks. It repels irritating mozzies and other nasties.
And it's water resistant.
Advantix. Now that's advanced pet care.
I really want to start my own business.
I just need that qualification.
I'm ready to take the next step up.
Well, now you can. Choose from over 40 accounting and business online courses at opencolleges.edu.au.
You know, it's one thing to say you're separating.
And quite another to go through with it.
And, well, now I need to look to the future.
And so I was after a fair property settlement, not a drawn-out legal mess.
And fixed fees, so I knew what I was up for.
And that meant calling 1-800 555 777.
Slater and Gordon. Not a problem.
Welcome back to Your Money, Your Call. I'm Mark Todd from FIIG Securities, and we have a caller on the line. We have Greg joining the panel. Hello, Greg.
Good evening, Mark, and thanks for taking my call. And good evening to Ben and Rudy. Mark, my question tonight to the two gentlemen, if they can help me, please. I currently own some hybrid securities, which are the Suncorp, Metway, SBKPBs, which are actually going to mature on the 6th of this month. I was wondering if the two gentlemen could help me. I'd like to replace those securities with something in the same order of probably floating rates or convertible notes or hybrids. I was wondering if they could suggest something for me. Thanks very much.
Well, I'll leave that part of the business to you guys, but if you have any interest in putting some of that money in the share market, then I would suggest a company called Ardent Leisure, a company called AAD. And they, at the moment, at the current share price, offer 8%, not franked, but 8%. And it's going to be 9 or 10% in 3-4 years' time. And then I think I'll pass on the ball.
In terms of the hybrid piece, I think a lot of these guys. I mean, I think a lot of the hybrids offer some good opportunity. The problem with the hybrid is the fact that once you're in, you get in for a long time. They're not that liquid, and the trouble being, your circumstances might change. I still like.
And they can trade as equity.
Absolutely, they trade as equity, and so that becomes a little bit of a problem, isn't it, Ben? Like you necessarily didn't want equity, you wanted a nice fixed return, or say you've got an equity that didn't perform well. To our way of looking at it, we come back to the original slide where we showed the NAV cap. It's a great bond. It's in the low 4s. It's a nice return, and it's not in a massive duration. It's 2016 is the expected call date, and I think that just becomes an attractive option to a client. So you can ring up a stockbroker and ask them for some advice. Clearly, we can't recommend all the stuff. But you need to talk to a stockbroker about it, getting some advice around what fixed income assets are around, and then taking some time out to drill back into the paperwork on this stuff, because it gets to be very complex.
And probably get informed about the risks as well, because we tend to look only at the security and what we get on offer.
Yeah.
But there are risks to instruments, yes.
Yeah. We have an email from Patrick, the first email from the night, and Patrick says, can the panel please give us an example of 100% franking and 30% franking and how this is working with my tax return, which is what they're doing with the Westpac?
Yes. Well, I'll do it with shares. I mean, franking basically has a big influence, only if you're in retirement stage or not. Otherwise, you have to deduct it or add it to your own tax return. And the difference between 100% and 30% or 15% is simply mathematical. I mean, a company like QBE will pay out an X amount in dividends, and at the moment, if my memory serves me correctly, only 15% of that total dividend is franked, which means that, to calculation, 85% of what you receive has no imputation, is thus fully taxable. And a company like, let's take another one, Macmillan Shakespeare, has 100% franking, which means the full dividend you receive twice a year is fully deductible from your tax, basically.
And so basically, if you have if you get $1, and they say 30% is fully franked, you can go and claim the 30 cents.
Yes,
you can say, okay, I need to get whatever my tax rate is on the 30 cents. I need to apply that to the corporate tax rate that was paid. So if I'm higher or lower, so if you're in a self-managed super fund and you're paying 15 cents in the dollar and the 30% tax on that 30 cents gets rebated to you, so 50% comes back to you.
The trick is, if I can just, the trick is that if you have a full portfolio, you only need about a third of your total dividend income to be fully franked, and you actually don't pay tax over your full portfolio of dividends.
So for those what Rudy's talking about is that there's a great article that came out last week by Chris Cuff. He's got this, I love it, it's Cufflinks.
Yes.
That's his article that he puts out, and he writes to that point, that when you look at a portfolio, don't think get everything fully franked, look at the underlying assets,
you
work
need
out
a third.
what works. But he said 32%, that worked, that created for the average portfolio enough that meant the tax was quite minimised.
Yes.
We all like to pay tax because we like to help everyone get good roads and schools. Moving on from some of the franking and the complexity around, how's business with you guys in terms of the privatisation world? And we were talking about, if you can point to, before we go to the privatisation, can we talk about the two different private equity deals? There's Dell that's come up, there's Warren Buffett, and we were talking before we went offline, the cheapness of cash is potentially creating the bubble that everyone's worried about, isn't that right?
Yeah, there is a concern, I think, but it's probably greater overseas, that impact, than it is here, because one, the margins or the actual absolute rates are lower in the US and the Northern Hemisphere than they are down here. I mean, you're still going to be paying 5, 6, 7%. Whereas overseas, it's virtually free money.
2.5%.
It's 2.5%.
Unbelievable.
The other thing is the availability of debt. So, I mean, we were just talking about the Heinz deal, and I know that wasn't a highly leveraged deal, but there was 6 times senior debt in that, 6 times EBITDA.
Yep.
Down here in Australia, you'd struggle to get more than 4, and some sectors of the economy you wouldn't even get 4 times EBITDA.
Right. Yep.
So, and then actually I must correct myself, it's not always 6 times senior, but it's total you'd get 6 times leverage, so you get probably 4 times or a bit more, and then you get some mezzanine and junior debt in the US. We just don't have that depth of market here, so it tends to cap out the amount of leverage you can put in, and therefore that keeps more of a cap on prices than it would in, say, the US.
Do you, and this is a question to both of you, do you think the state of play in corporate America is such that some of those balance sheets are now so strong, you can see companies like Microsoft saying, I'm going to spend $2 billion in making sure Dell performs in the manner I want it to, because they're not desperate now. They've it's been the jobless recovery. A lot of these companies are very solid companies now, and they're looking to expand. So you see Boots was bought out of the UK. Let's just go and buy a couple of $1 billion and I'll buy that company out of the UK. Taking advantage now when prices are quite cheap because of some of the equity performers in Europe in particular.
They've actually already been doing that, but in a different format. Not many people realize, but a lot of companies in the US that didn't used to pay dividends or only a very small amount have been steadily increasing their dividends over the past years. Plus, and that's because of the tax system there is more weighted away from dividends, a lot of them have been buying in their own stock.
Yeah.
And one of the reasons why some people think that the US share market has performed so well is because the amount of stock available has actually shrunk.
Yeah, and the money's still around.
And so they have to balance, but they already were using that to basically to please the shareholders and to promote the share price.
We've got Justin on the line. Justin from Canberra. Sorry, we lost you before.
Yes, sorry about that.
That's all right.
Just got a question on your view on the Sydney Airport bonds versus equities. I've currently got a stake in Neon Energy, and a bit of advice on whether you would be looking to increase sort of that, which is a bit of a secure-looking spec at the moment, or as opposed to bond, which is probably a bit more security in it.
Justin, again, we always like to find out a little bit more about the customer so we can understand the size of your portfolio and what you're looking to achieve. But essentially, the Sydney, we had it up last week, the Sydney Airport inflation-linked bond is a standout bond. That's a bond that when you buy that one, you look back at hindsight and say that's a misprice. So it's just such a great opportunity. And it's because the world economies are pumping so much money, so it's not a question of is there inflation. You're trying to mitigate the timing of the inflation. So you just say Sydney Airport 2030 bonds are producing 4.25% over the CPI rate. So CPI is at 2.5%, 4% over CPI. 6.5% return on a senior bond. I think it's a great opportunity, and we're being given the wind up. You can't speak. You see, I've got 30 seconds, so I can come back and say how much we enjoyed having you all on. But again, we do think it's great to have you on. It's been really interesting stories. I've got Ben Smith, Managing Director of Investec, in charge of all the privatisation. We didn't get a chance to talk about how the governments are looking to privatise, and people like you come over and give them some answers on how to sell some assets.
We have to come back and do that again.
And Rudy, thanks very much. FN Arena, you've been a great guest. It's been my pleasure. And that's Mark Todd from FIIG Securities. Have a good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.